One of the ironies of your business is that the best time to raise money often isn't the best time to spend money. As we both know, and as other people will say, public equities are very fully valued right now. How would you describe conditions for private equity?
Well, I think, as you said, I mean, the values in the public markets are high. I think any metric you look at would suggest that. But our job is to really go find opportunities within an otherwise highly valued market. And there are discrepancies, sector by sector, company by company. So today, I think we think there are some very attractive opportunities in healthcare. And also where you can deploy capital behind your portfolio companies that have synergies when they're looking for acquisitions where we're not looking at just standalone buyouts. I think that could make a lot of sense as well. So yes, the market is highly valued, and as a result, I think you need to be cautious at this point. But there are sectors and there are ways to look for good opportunities that can still make a lot of sense for private equity investments.
Doesn't sound to me, though, like you're in a hurry to deploy capital.
No, we're not in a hurry.
Not with things where they are now.
As you know, our investment period for each fund is 6 years. And so a big part of what our job is to be patient and find the right opportunities at the right time. There'll be times where you really want to lean in, and there are times where you need to be a bit more cautious. And I think right now we want to be more cautious, not just because of the valuations, but there's obviously a fair amount of uncertainty around the world and even in the U.S.
Let's get into some of that. Going into the election, KKR was anticipating an economic downturn at some point in the next couple of years.
Right.
What do you expect now?
Well, I think we're still trying to put everything together. There's not a lot of certainty with a lot of the policies that are being discussed, and while many of them will be very good for the economy and for growth, there are others that may not be. And so we really have to take a step back. But what our most recent thinking is that we probably will push out the slowdown that we were talking about. And we had initially, as you mentioned, talked about a slowdown sometime in the 2018 period. Now we think, given some of the strong economic data coming out of the U.S., some of the pro-growth policies that the new administration is advocating and hopefully can get through, we're probably looking at a slowdown in the 2019. So it's pushed it out a year. We don't think it's been eliminated. Who knows whether we're right or wrong, but we don't think it's been eliminated. We just think the strength and the optimism and the momentum has probably pushed it out for a year.
Given what you hear from the White House, Alex, given what you hear from the House and from Congress, how much confidence can you have in the pro-growth agenda that the president has put forth, and in particular, some of the policies in which, as they say, the devil's going to be in the details?
Right. Well, look, I think we have the broad contours of what some of the main policies are certainly the goals. And I think if you think about broad tax reform, you think about repatriation, you think about the potential to have a significant amount of spending in infrastructure, and deregulation. I think those all are quite positive for the economy. Now, how much of that, at what time, and what the legislative success may be, I'm not an expert in Washington, but the experts tell me, you have to be cautious about it because it's not all going to happen, and it's not all going to happen at the same time.
I guess that's what I'm getting at. If you have to be cautious, right, and you don't know how these policies are going to take shape, how do you invest confidently? Right. For example, in the case of tax reform. Yeah. Tax reform is going to create winners and it's going to create losers. Do you really want to step in front of that train?
Well, I think you raise a good point. I mean, that's part of the reasons I mentioned earlier that there's enough uncertainty right now where you have to be more cautious. And there are certain sectors, as you said, I mean, the retail sector comes to mind if the border adjusted tax comes through as is described. that would have a pretty significant impact on that sector. So looking at those investments, I think you have to really step back and say, do we want to jump in right now? Do we want to wait? And our focus has been more in areas where most of the products are produced in the U.S. And so that's across all the different industry segments that we're looking at. So, I think, I don't think you can just sit there and say we're paralyzed, because you do have a set of broad contours that are out there. But I think in every case, you really have to take into account not only the fundamental economic tailwinds and metrics, but also the potential policy implications that are going to come through.
I know you and your colleagues have been doing the math, let's say. If you lose the ability to deduct interest costs, how much lower does the corporate tax rate need to be to preserve current deal economics?
That's a good question, and we do spend a lot of time, as you can imagine, thinking about this. And you really have to look at the overall tax reform in its totality, because you really are not going to have unbundled pieces. You really are talking about an overall package. I don't know ultimately what the overall package is going to look like, but from what we understand, if interest deductibility is eliminated, or some big portion of it is eliminated, there's likely to be a full expensing of capital expenditures. And it really isn't going to happen unless the overall corporate tax rate comes down. Exactly where, I think the sensitivities will really depend on how levered is the company, how much tax are they paying right now, period, and different structures that they have. So it'll be a moving target, but from everything we see, it'd have to be tax rates in the 20s that can really make this more neutral. Is it 20%, 22%, 25%? It's in that zip code, right. And it'll really be more case specific. But I think it'll need to obviously be significant from where it is today.
Alex, the image many people have of private equity, multi-billion-dollar leveraged buyouts, is a bit dated, wouldn't you say? We both know, yes, you better than me, that the model has evolved. This fund you've raised in particular has a sleeve to make public equity investments. Help people understand the way KKR is looking at the private equity business, in particular the way to deploy capital now, and how it differs from the way it used to be.
Sure. Look, I think, as you've said, the entire industry has evolved. I remember in the early days, people say, well, the buyout industry, that's easy. You just pay low, sell high, and put a lot of leverage on it, and everything works out. Well, it didn't quite work out that way, but it was certainly an interesting way to look at it. Since then, I think the industry and certainly KKR has put in a lot of effort to build up the resources to have operational capabilities, so that we're not just capital. We can actually go into companies and help the management team build the business, grow the business. We have a differentiated pool of capital, flexible pool of capital. So flexibility of how we invest, I think, is critical. We can now, through all the work that we've done and all the different parts of our firm, we can invest up and down the capital structure. We can invest across a lot of asset classes, so real estate, energy, infrastructure, credit, private equity. And I think the totality of all those capabilities allows us to not only have flexible capital, but provide solutions for companies, rather than we're here to just talk to you about buying your company or buying a division. Oh, sorry, okay, we'll come talk to you next year. Now we can go and say, what can we help you with? What are some of the issues that you're dealing with, and how can we help you with our capital and with our resources? So
the giant leverage buyout of the pre-crisis era is largely gone. Deals are smaller, but the pricing right now is not. The average multiple on U.S. buyouts, I was shocked to see, was 10.9 times EBITDA in the third quarter.
Sure.
Does that surprise you? Is this industry losing its discipline? Hard-won discipline?
Well, I don't think so. I don't think the industry is losing its discipline. I think multiples have expanded. But I think if you look at that multiple is obviously an average. It's a median of lower multiples, higher multiples, some growth investments, and others that may not be as much of a growth investment. And if you look at the returns that the private equity industry has delivered as an industry over the last decade, 5 years, any which way you want to cut it, it's quite significant and quite a premium over other large indices that you want to talk about, the public. So yes, multiples have moved up, and that's part of the reason why I said we're going to be pretty cautious right now, because it's highly valued. But I think the investments that you see from private equity really range growth-related companies, minority investments, investments that take control over companies and help management teams grow. So the array of types of companies and type of investments have really broadened over the last really 2 decades. So yes, the multiples are going up, and that's something that we obviously watch. But more importantly, you have to really look at the underlying companies that we're investing in. Are they growth-oriented? Are they global? What are the themes that you're pursuing with those investments?